In today's video, I'm going to be sharing with you how to master market structure, all of the tips, the tricks, and all of the things I've learned and understood from my years of experience to understand the next swing point that's in the market. You're going to learn how to determine where the swing point is going to come in using the same repeatable and consistent process. Just before we get started, Chuck's brand new 1 minute course is out right now. If you want to get access to that, we have a 10% code that is on for a limited time only. Check the description of this video for that code. You're going to learn Chuck's exact strategy, which enables him to get into trades that make 10% profit every week. Every step of the strategy is broken down in his brand new course. Also, I know I say this every single week, but it's outstanding how many consistently profitable traders we already have in our community. We have less than 100 traders here and over 20 consistently profitable traders. You'll never see another community with such a high volume of consistently profitable traders than anywhere else. That's because all of our traders go through our diamond program. We work with our traders that are at break even or already profitable with our concepts, completely free in our diamond mentorship. Me and Chucks dedicate our time to work with these traders one-to-one. And that's because we have big goals with NJT and private funding. So we're training our traders to become the best that they can be to trade large funds. So let's start here. What is market structure? I think a lot of traders, when they think about market structure, they only see trends in the market. We see swing highs and swing lows, swing highs and swing lows in a bearish trend. And then we see swing lows to swing highs in a bullish trend, swing lows to swing highs, swing lows to swing highs. This is a trending market structure. There are 3 different market structures because we can break down all of these sections into ranges, initiations, and trending market structures, but we'll just focus on a trending market right now. This structure, this market structure is framework. It's what's left behind. The intention is the now, what is being planned and created ahead of time to create the market structure. Market structure is like a lagging indicator. We want to know what that next move is going to be before it happens. And this is where sideways ranges come in. If we can determine what ranges price will react from by reading the price moving into these areas and seeing changes of intention, we can predict the next potential swing points as they are happening. Every single swing point, which I'm just going to mark on the charts right now, has come from a previous sideways range in the market. So if we can determine where the previous swing points are and we can look left in the charts, then we can determine where the next swing is going to come from as well. These are all the swing points that we can see on the charts right now. So what I've done is I've marked them all on so we can start to look left and see where prices come from, and the price action on the right-hand side of the charts, we can see what price has in common. This is just learning from price action. This is all price action concepts that you can learn in our price action course. This is before we execute a trade. It's really important to understand and analyze what price is doing and make a consistent process of how you read the charts. We need to make sure that how we analyze the charts is consistent, how we trade the charts are consistent, and how we execute our positions are all consistent. That is what creates consistency in the way that you trade your system, and that's what creates consistent profitable results over a series of trades. So this is just one of the elements that we always look for. So these are all the highs and lows within the markets that are all the swing points. Now, if you don't understand the RIMC model, it is ranges, which is sideways price action, followed by initiations to the upside. This is where prices contain between a high point and a low point before we break out. Now, this has already been printed on the charts. For example, here we see a sideways range and an initiation that's already been printed on the charts. We also see a sideways range here and an initiation to the downside that's already been printed on the charts. So all we want to do is determine and identify a previous sideways range and an initiation. That's where prices just contained overall sideways, followed by an initiation out to the upside. This first part here gives us our intention. Now, it's really important to understand this first part because this is how you're going to be able to read the next swing points within the market. So when price pulls back here in the future in current price to a previous sideways range on the left-hand side of the charts, on the right-hand side of the charts, which is current price, we want to read the price action moving into this area. Because if price comes into this area, let's say this previous sideways range that we have here on the charts where price is contained, and we see that price moves into this area very aggressively and doesn't stop and just flies straight through, instead of just taking our trades here and putting a limit order or a stop order here and waiting for price to get there and just executing it, if we can read the price action moving into the area and we can see prices wanting to slow down, this is adding an additional element, which is adding to the edge of our system of saying when price is actually going to turn from a point of mitigation. Now, this is the whole RIMC model. range, initiation, mitigation, continuation. We see this happening all over the charts all the time. Previous sideways ranges, initiations, pull back into that range in the future, mitigation, and continuation to the downside. This happens on a consistent basis, range, initiation, mitigation, continuation. Again, we see here, sideways range, initiation, mitigation, continuation. Price is following this same order flow pattern over and over and over again. And when we see ranges get left here, they are then used in the future for a different intention when we pull back into this area. Now, if we can identify previous sideways ranges on the charts and we can read the price action moving into this area slowing down, this is where we can take our trades from in that overall direction in the market. Now, every single reaction from a swing point is always going to come from a previous sideways range in the market. So if we just draw those out now, here, prices contained sideways, we initiate to the downside, mitigation, continuation. Here, prices contained sideways between the low and the high before we break out to the downside, initiation, mitigation, continuation. This is a whole sideways ranging market where prices contained sideways here before we broke out there to the downside. Again, we see price comes back into that point of mitigation and we see continuation to the downside. So I'm just going to continue drawing all of these on. Again, all we're looking for is where prices contained sideways on the charts, followed by an initiation to the downside. Price is either going to pull back here in the future and see continuation. And we can also see price coming back here again at another time and seeing a mitigation again. This is okay. It's fine that price comes back into the same mitigation point multiple times because we can still play that same intention again in the future. Again, here we see a previous sideways range on the charts, followed by initiation there to the upside. That becomes our mitigation continuation and our next swing point that happens within the market. Here we see prices contained sideways before we break out there to the downside. So this whole area creates all of these mitigation points before we then see continuation to the downside. We can see previous sideways ranges on the charts as well that initiate to the downside. If price doesn't run above the high of this range here, the high of this point of the range here, then we can still play the same intention again in the future when price comes back into this location here in the future. This low that was created in the market, if we just zoom out and look at price on the 15-minute chart and we think about where prices come from, here, if we look over to the left, prices contained sideways here before we broke out to the upside. And this is where price is reacting from here in the future. When we see price initiates there to the upside, that creates the next swing low within the market, which also creates the intention for higher prices into this location. So now there's a few tips for understanding what price is going to do when we get into these previous sideways ranges. So we've marked out all of these areas that we have here on the charts, all of the previous sideways ranges. So now all we want to do is look at what price is consistently doing as we come into these areas in the future. This is another one of our concepts to understanding how to read price action moving into these points of mitigation. Because we've identified our previous sideways range on the left and initiation to the downside, which I'll just draw here. The initiation is normally aggressive move in one direction, and it's a breakout of a sideways range, which shows us the intention of that sideways range here in the future. This is showing intention for lower prices, and it's also giving us an area overall in the future that we can then look to trade the mitigation continuation phase following our bearish order flow pattern within the market. Now, what's something that price has in common for all of these areas here in the future? Well, we want to read the price action moving into these points of mitigation. If we know that these are the areas in the future that price wants to mitigate and see a continuation from, then what's going to show us or determine that price wants to slow down? Well, it's when price comes into these locations and we see runs above highs and we don't extend, and then we can play our continuations there to the downside. Again here, price runs above this high, strong rejection, and then we start seeing a move here to the downside. So this is our step number 2 for understanding that price is going to react from these locations here in the future. Every single time price comes back into this area, we see one of two things. We either see a strong rejection of higher prices here. Let's just remove this to keep it clean. We either see a strong rejection of higher prices at our point of mitigation here in the future, and then we can trade alongside that intention to the downside. Because remember, all we're doing is understanding direction using the RIMC model. Points of mitigation in the future are giving us our overall direction that price is broken out here to the downside. Because this range has broken to the downside, that means that this is a sell range. So when price comes back here in the future and we start to see strong rejections and continuations away, that's given us again our direction to trade from in the future. So we don't have to guess, we just have to identify, see that price is either having a strong rejection or running above highs and not extending, and then we can determine that price is going to react from this area And then we have our overall direction to trade here in the future. So those are the two things that we really look for that are going to determine if price is going to react from our location. If we have an example like this here, where we have a previous sideways range here in the market and we extend this across, now because prices come back into this location here in the future, we haven't seen a strong rejection. We haven't seen price running above a high and not extending and moving in the opposite direction. So here we are avoiding taking losses within the market because we're not seeing any slowdown within price. So this becomes a range that we can identify on the left, but because we haven't seen our two important points, which is price slowing down or seeing a strong rejection and moving in the opposite direction, we then don't trade this range. This is what actually increases the probability of these trades playing out in the future. So it's a very important point to understand when we're looking to identify. So here again, price is contained sideways between the high point and the low point before we break out to the upside. For me, I don't draw these on until price gets into this location, right? I can identify every single sideways range on the charts. I know what I'm looking for. I know what they look like. So all I'm doing is waiting for price to get here in current price in the future, see a reaction or start to slow down. Again, price running below lows and not extending. That shows a slowdown at my point of mitigation. And then I go left and I draw on my sideways range and initiation, because now I know we're at a point of mitigation. I've seen everything that I need to see in current price for price to slow down, or a strong rejection from that area, showing that price is potentially going to see continuations from this previous sideways range. And then I can play alongside that intention for the continuation phase to target the high that was created from the sideways range. This is how we're able to see the next swing points that happen within the markets, and how we're able to determine if price wants to slow down from these previous sideways ranges, or we just want to run through these previous sideways ranges and see continuation. Again, we see here, this is our higher time frame sideways range. So what do we see as price moves into this location, run below this low, and we don't extend, and we also get that strong rejection of lower prices as well. Again, we see here, price runs below that low, don't extend, and we get the strong rejection of lower prices as well. So this is showing that price is slowing down in an area of a previous sideways range on the charts where we anticipate the next phase of price, which is always the continuation. So this is where I'm always looking to take my trades from. I always want to see price slowing down at points of mitigation here on the charts, because then I'm entering a trade on the next swing point within the market. Again, here, previous sideways range on the left at the point of mitigation. And then overall, I have my direction that I'm trading in to the downside. This is a staple in my trading system to trading the overall direction. This is reading the price action moving into our points of mitigation, because we're always taking our trades from points of mitigation in the future. Always looking for sideways ranges on the left, initiations, points of mitigation, wait for price to slow down, see strong rejections. That's at our point of mitigation. And then we have clear direction in the market all the way up into the previous swing high that was created from the sideways range. So it's exactly the same in current price here. Because we're coming from a previous sideways range and initiation, this is our mitigation point. What did we see as price moved into this location again? We saw price running above this high, not extending. That's showing price is slowing down. And then we see continuations here to the downside. This is why a lot of the traders inside the community were looking for sells on New York Open for continuation to the downside. And we're able to capture a lot of percentage in the move here, because we're just following the same process. We're utilizing price action and the reading of price action at locations where we anticipate price to slow down. Then price does slow down, and then we can play continuations away from these locations. Once you've got that direction understanding within the market, you can understand that this could be the next swing point within the market. And what's one other thing that I use to understand and determine swing points within the market? The next thing that I'm always looking for is these ranges to create swing structure breaks within the market. When ranges break swing structures, that shows intentions for lower prices. So all of these things combined together, seeing price pulling back into a previous sideways range, slowing down, seeing a strong rejection at the point of mitigation, can all determine the next phase of price, which is the next swing move that's happening within the market. We can see all of the swings come from a previous mitigation from a sideways range. And every single range has broken a swing structure, and every single continuation has also broken a swing structure here to the downside. We see that was the previous swing high here. So this range caused a swing structure break. When we pull back into this mitigation in the future, wait for price to slow down, wait to see a strong rejection, and then play the continuation phase, which is the next swing point that's always in the market. It's exactly the same here. This sideways range here broke the swing structure low that we have down here. That's now saying that this range here we can play as a trade idea in the future. So now if we play the mitigation and continuation phase, what's the thing that we always want to see as price moves into this location? A slowdown here, run above a high, no extension at our point of mitigation, and then we can play the next continuation phase within the market. This is then the next swing point that we're always playing. I'm always taking my trades from a previous sideways range. They always have to cause a swing structure break so that I know that I'm then playing the next potential swing move in the market, which is always going to increase the probability of catching a trade with a positive risk to reward. So even if some of these don't play out, either to the upside or the downside, and you've got involved in these trades, as long as you're only risking 1%, when you're going to lose, you're going to lose 1%. But when you're winning, we can see that the continuation phases from all of these points of mitigation are all given very large risk rewards. So for me, I always use a 10 pip stop loss, and I always aim for a 1 to 4 risk to reward. So you can see most of the time when you're getting the correct direction from these points of mitigation here, playing the continuation phases, price is moving beyond 40 to 60 pips within the market. So this is giving us a repeatable framework that we can always use to build high probability trading ideas, utilizing the same repeatable rules over and over and over again. This is how I use the RIMC model and market structure and ranges that cause swing structure breaks and read the price action moving into these previous ranges to create my high probability trading ideas that I then look to trade during New York session with my entry strategy. Every single trade idea I take has to follow this same repeatable framework. Otherwise, I sit out of the market. This is the framework to every single trade that I take. If you want to find out more about how we trade these markets and you want to learn my 15-minute strategy, which is taking advantage of all of these moves in the market during New York session, if you enroll at notjustatrade.com, you will get access to all of our content. And I'm teaching this strategy every Tuesday on live webinars as well. Thank you all for watching. Make sure you leave a comment down in the comment section if you enjoyed this video, and I'll catch you guys on the next one.